$300,000 just left your bank account in taxes because you thought a Section 1035 exchange locked in a tax-free outcome forever. It didn't. High-income professionals swap underperforming life insurance policies all the time using IRC Section 1035 exchanges, believing they've achieved permanent tax deferral. Then they surrender the new policy years later and discover the IRS is treating the entire gain as ordinary income. For a household in the 37% federal bracket plus 8% net investment income tax, that $120,000 gain on a $300,000 surrender just cost $45,000 in tax liability they never anticipated. By the end of this video, you'll understand the exact basis carryover rule that makes this happen, when surrender timing triggers gain recognition, and whether your current policy structure is walking into this trap. Let's start with the wrong belief, the one most CPAs and insurance advisors don't correct. You think, I executed a Section 1035 exchange. The IRS confirmed it. My gain is tax deferred. Then you surrender the new policy 5 years later and expect zero tax. The IRS publication 525 says otherwise. Here's the exact rule. IRC Section 1035C requires that your adjusted basis in the old policy carries forward dollar for dollar into the new contract. If you don't track this, or your advisor doesn't, you're flying blind. When you surrender the new policy and its cash value exceeds that inherited basis, the difference is taxable ordinary income, not capital gains. Ordinary income, that's the delta. Real math, you own a $300,000 permanent life insurance policy, a universal life or whole life contract. Your adjusted basis is $100,000 because you paid $100K in premiums over 15 years, and the policy had $0 cost basis at issue. The cash surrender value is now $220,000. Underperformance in the low-rate environment means you want out. You execute a Section 1035 exchange into a newer, better-performing policy. No tax. The basis of $100,000 carries forward into the new contract. You feel safe. Fast forward 3 years. Interest rates have normalized. The new policy's cash value has grown to $280,000. You surrender it. Gain equals $280,000 minus $100,000. Inherited basis equals $180,000 in taxable ordinary income. At a 37% federal rate plus 8% NIAT plus, say, 5% state tax, your total is roughly 8%. You owe $82,440 on a surrender you thought was tax-free. Now here's where it gets worse. You're not filing this as a capital gain. IRS publication 525 is crystal clear. If you receive amounts under a life insurance contract that exceed your investment in the contract, the excess is taxable as ordinary income. This means every dollar of gain stacks onto your W-2 income, potentially pushing you into a higher bracket and triggering the 8% NIAT on investment income if your modified adjusted gross income tops $200,000 single or $250,000 married. Most high-income earners don't expect this because they executed the Section 1035 exchange correctly. The IRS approved it. The policy was swapped tax-free. But the surrender rule and the basis carryover rule are two different animals. One does not imply the other. Let's address the timing issue, the thing that costs you the most money. If you know a policy is going to be surrendered, the worst time to execute a Section 1035 exchange is right before that surrender. Why? Because the basis carryover is locked in the moment you exchange. If your old policy has a $100K basis and you exchange it at a $220K cash value, that $100K basis moves to the new contract, no matter how much the new contract's cash value grows in the meantime. Every dollar of that growth, when surrendered, becomes taxable gain. The better timing strategy, if surrender is inevitable within 3-5 years, surrender the OLD policy before the Section 1035 exchange. Yes, you'll pay tax on the old policy's gain upfront, but you know exactly what the number is. You can plan for it, spread it across 2 tax years if needed, or claim it in a year where you have offsetting losses. Then once that's done, you exchange into a new contract with a fresh basis equal to your cost of acquisition in the new policy. No inherited basis, no surprise gain cascade. This is the strategy tax attorneys quietly use. Calculate the gain on the old policy, decide whether to surrender it pre-exchange or post-exchange based on tax bracket positioning, then execute accordingly. The open-loop tease I made at the top, exactly when does the IRS arrive, happens at surrender, specifically on Form 8949 and Schedule D, or Schedule 1 if the gain is ordinary, not capital. The gain is reported as ordinary income on your Form 1040. There's no hiding it, and there's no retroactive basis adjustment if your advisor failed to track it correctly. Now the stakes. High-income professionals holding $500K $2M in permanent life insurance policies, often accumulated through employer plans, buy-sell agreements, or long-term wealth strategies, are facing this trap in real time right now. As interest rates normalized from 2022-2024, Policies issued in the 2010-2016 low-rate environment are chronically underperforming. Surrender requests are up, and the IRS, per publication 525, hasn't changed the rule. Gain is gain, basis carries forward, and surrender is taxable. One final actionable detail: if you're considering a policy swap in the next 12 months, request a cost basis statement from your carrier today. Know your exact adjusted basis. Then work backward if you might surrender within 5 years. Model the tax impact both ways: surrender pre-exchange vs. post-exchange. $1.50, $000, $100, $000 tax decision should not depend on advisor assumptions. It should depend on your numbers. The tax code rewards those who study it.